Hey there, speculators. It is Roderick, lead futures trader, Futures on Fire, where we trade futures for daily income on a virtual trade floor at tradersdevgroup.com/futures. Hey, in tonight's video, I'm going to talk about something that maybe many of you futures traders, and if you're an options or equities or ETF trader as well, you don't think much about, and that is bonds. All right, let's go ahead and fire it up. Okay, so what we're going to talk about tonight is the bond market, and specifically bond futures. I'll also get into a little bit about some ETFs that equate to these bond markets. But just really quickly, the first thing to take away, and the reason I'm making these videos right now is because I'm doing it at a period of time in which we've had some heightened volatility again. So it's been a while, all through 2019. We really didn't have much volatility. The last time we saw pretty pronounced downturn in the market was December of 2018, right around the Christmas time frame is when it sort of pinnacled, or the crescendo. And then we also saw it back in the early part of 2018. Of course, we had a lot of volatility around the election in 2016, and then there's been pockets since. But 2019 was a relatively quiet year, and now here in the very middle part of the quarter of 2020, we're seeing significant volatility and sell-offs in the market due to the health concerns around the coronavirus. So it brings me to a point where I want to talk a little bit about inverse correlations to the markets. So most of you futures traders, many of you are probably focused, like I have very often, on the stock index futures, things like the Dow Jones, the SPY, the S&P, which is the ES, the Russell, for instance, the NASDAQ, of course. These are great markets. You can focus only in on those markets. You can earn a very good living just focusing on those particular markets. But this is a good time where it also makes sense to at least broaden your horizons a little bit and take a look at the bond market, because typically the bond market puts a lot of us to sleep, and the bond future specific, a lot of the times are just not moving that much, so they don't provide much opportunity. However, in these sort of unprecedented times where interest rates around the world have already been at zero, and now the US is finally looking like it might catch up, I'm not saying things are going to go to zero, it's time to at least take a look at these bond products. So what I'm doing is I'm looking at the ZB1. Now this is if you just type in ZB on TradingView, you're going to want to look at bond futures, and I'm just looking at the continuous contract. Okay, the contract that we're trading right now at the time of making this video is the June 2020. So you just type in ZB, go to continuous contract in futures, and if you have a pro account, I think you should be getting 20-minute delayed data on this particular contract, which is fine for our purposes today because I'm just looking at a daily. I think the daily might be even available for free on TradingView. If you want to know more about TradingView, a great online free charting package with some upgrade available, you can check the link below for a deal on TradingView. It's the primary charting package that I use. It's where all of the Traders Dev Group and Futures on Fire indicators actually run, which, by the way, that's what we're looking at right here, these stripes right here. All right, so the first thing to take away is let's just look at the SPY, for instance. We'll go to the SPY, and what's it doing? It's going straight down, right? We just made a new low here, and it's been a pretty significant sell-off very quickly, a little over 10%. Now, if I go back to the ZB, this will give me an opportunity to re-show you this front month contract. Oops, sorry, I want the continuous contract. ZB continuous, I think I did that right. I just want to make sure. Yeah, ZB continuous contract. Okay, it's the exact opposite. It's essentially going straight up here, straight up in a pretty pronounced way. For those of you that are not familiar with this particular contract, I'm not going to spend too much time on it now, other than to say that between 170 and 172, 173, 174, 175, there's 32 ticks in between. Each tick is $32.50, so it's $1,000 per point per contract. So it's a big product. It's a very big product, and right now it's working about 90-ish% inverse to what the S&P is doing. So the bonds are going up as people look for a flight to quality, or at least locking in some hedging against the market that is going significantly down. So here's the reason that bonds become interesting in this particular environment. And again, like everything that we do on Futures and Fire, we're technical traders. We're not going to get too much into the macro nature of whether interest rates are going to go to zero, which would cause bonds to go significantly higher. But the focus for today is just to use, to know when it makes sense to look at these other markets, because one, they give you an alternative to how you might be trading the volatility that's existing in the stock index futures. Because what are our choices as futures traders for the most part, if you're not using options on futures, is long or short, right? And which instrument do I want to go long and short? Am I going to short the S&P at these particular levels here? Do I want to try to pick a bottom? Well, if you short the bonds, it's actually the equivalent, not perfect, and this could change, but it's the equivalent of going long the S&P a little bit. In other words, if the bonds come in, there's a good chance that the market will stabilize and you'll get a synthetic or a different alternative derivative play on being long the S&P. Hopefully that makes sense. Now, another thing that we look at is something like the VIX, right? So look at this VIX. I'll widen this up a little bit, okay? Extreme turn signal here, by the way, which was a nice winner. Extreme turn signal here, sell, which was not. I mean, you took a tremendous amount of heat. You had to get stopped out on any sell here. Now notice though, the condition of the extreme turn in the VIX is actually no longer present, even on this very significant spike off. And so this is what the VIX did. Kind of looks like a blow off top on the close of this particular day. And it corresponded with the markets firming up a little bit, although still being red on this particular day. I won't go back and look at those. So what I'm getting at is here's all the things that spin through our head when markets get very volatile. Okay, do I buy puts? Do I sell the stock index futures, try to sell into this weakness to look for further declines, either on a directional basis just for purely speculative income, or to protect against my long portfolio, my 401k, things of that nature? What many people are not thinking of is the bonds, and using the bonds also as a way to express a position, either hedge or directional. And where I'm going with this is, I believe, and I don't normally make kind of market calls, but I spent a long time on Friday and this morning trying to calculate where the 30-year bond, by the way, the ZB is the 30-year bond future. The other very popular interest rate futures product to trade is the ZN. There's also the ZF, which is the 5-year. There's a 2, 5, 10. There's everything in between. There's a lot of bond or interest rate futures products. I like to trade the ZN, the ZF, and the ZB. So that's the 5-year, the ZF, the 10-year, which is the ZN, and the 30-year, which we're looking at here, which is the ZB. Now, as I often point out, when you're talking about shorting anything in the futures markets, they are not equities, right? But we have to understand that these things could go to infinity, right? Bonds could potentially go to infinity. Well, technically they really can't. They could go much higher if interest rates actually go to zero or negative in this country, which could happen. I'm not an economist. I have no idea if that's going to be the outcome. But the price action that we're seeing here, and the fact that we had 1, 2, 3, 4, 5, 6, 7, 8 continuous days in which an extremely oversold condition, overbought condition existed in the ZB, the 30-year bond futures contract. While at the same time, by the way, this is not only just an RSI, this involves also ATR expansion and an ADX that's absolutely directionally off the chart. So a strong move up. And this crescendo day to me looks pretty close to a blow off top. So while I'm not, and I can't call any kind of market turn in the bottom of the stock index futures, I can feel comfortable beginning to express some short positions in this contract. Now again, $1,000 a point, it's a very big contract, and there's really not perfect equivalence in the futures markets for this particular contract. So in just a moment, I'll switch over to the contract to the instrument that you can use as a proxy if you're not yet involved in futures. But if you're not involved in futures at all, check the descriptions below for more information about how you can find out about the futures markets. Okay, so what this extreme turn signal is telling me is that now is the time to look for short entries in the bond market as a way to make a directional bet on bonds coming in. Okay, now in order for this trade to really play out, the market will probably have to stabilize in here, but at this point, without getting too wonky here, these bonds are almost pricing a 40% decline. Now their current price is almost pricing in a 40% decline in the S&P. So who's going to be right here? I don't know, but to me it looks like price dislocation. But all that aside, I'm just trading the extreme turn technical signal here. You can learn more about the extreme turn and the price action series of trading indicators that we have here on TradingView by looking at the description below. Also, I'll pause for a moment here. If you're new to the channel, or if any of this is sort of resonating with you, or it's confusing the crap out of you, you might want to just hit the like and subscribe button, turn on the notification button, and I'll do my best to continue to talk through this over the coming weeks as this begins to play out, because essentially I'm calling a little bit of a short-term top in the bond market. I got short pretty heavy on Friday. It's one of my largest futures positions that I've put on in quite a while. I did it right near the close. Unfortunately, the position's already favorable to me because we closed at like 179 when we got 179.22 when we got up to about 180.19, and I was short from a little bit above 180.06. All right. Now, speaking of that, these bonds futures instruments, they're somewhat confusing. I'm not gonna lie. There's some products coming out called from the small exchange from TastyWorks that I hope to be broadcasting more about in the future. No pun intended. That hopefully will normalize this a little bit more, so it's not quite as confusing to understand how these trade and how they work. But you can trade them if you have any futures account. You can trade them, and you can kind of learn the tick increments. Again, like I said, 32 ticks per point. Each tick is a little over $32. All right. If you're short here and goes up 3 ticks, that's a $100 loss on that. All right. So takeaways here. When the market is going down and you think, what are my scenarios? I can sell, I can buy puts, I can hold through it all, which is not what a lot of active traders are going to do. That's more of an investor sentiment. I can hold through it all, or an investor will put together their list of things they might want to buy if things continue to decline. But let's face it, these types of events are very scary to a lot of people. So, and I think the VIX and dealing with volatility is the deep end of the pool. It's not really appropriate for everybody. So one of the ways that you can look to participate in trying to find an opportunity to buy into very ugly looking stock markets is by shorting the bonds, because everyone's moving to the bonds at that particular time. Now, if futures are not your thing, the instrument to potentially look at is the TLT. All right. And again, if you want to, hopefully you'll be able to see here, here's an extreme turn sell that probably didn't work out unless you got it off the next day. Here's another one that probably didn't work out. Now, with the extreme turns, we're very impatient with them. We want to find a signal and then pretty much be rewarded and things are going right the very next day. So we're very impatient. So why I do want to point out, this didn't work. We're likely out here. We didn't take these two signals, but I did take some signals in the TLT when I also put on the ZB short as well. And I expressed those through bear call spreads. Again, I'm not getting into any options positions here, but you could just flat out buy puts, or you could do a bear call spread, which is a way of also expressing a decline or a peak in the particular instrument. Now, I did want to point out, as you see here, an extreme turn signal came in right here at around 166.81. Now, the TLT is not perfectly correlated with the ZB because the TLT is a 20-year basket of treasuries. It's an ETF that has 20-year treasuries, and the ZB is the 30-year treasury. But here's the good news. The yield curve is so damn flat that you're getting a pretty high correlation on this. So if my short ZB bond position works out, then any kind of short position in the TLT should also be profitable as well. Now, as it said in the very beginning, I do want to point out, since I don't very often talk about very specific positions that I am in, that futures trading is extremely risky, and you do need to understand the risks associated with futures trading. It's not suitable for all investors, and you do have to understand that. You can read more about the risks associated with futures trading at tradersdevgroup.com/notices, as it said in the disclaimer at the very beginning of the video. All right, so I'll leave it there for tonight. Just wanted to introduce the concept of bonds and the bond futures as an alternative to necessarily trying to pick a bottom or mess around with the VIX or do nothing in times in which there is extreme moves in the market. So take a look at the bonds, learn a little bit more about them. Let me just really quickly show you the other one, the ZN. So this is the 10-year note, and you would go to the continuous contract. You can see 1, 2, 3, 4, 5, 6, 7, 8, 9 days. So it's the old, hey, if you liked it here, you gotta love it up here. So this has been present, the condition's been present for about 9 days there. And it's kind of the the thing is like, enough is enough. And at some point, again, this is not Tesla. This is not Apple. There's no management in these companies. They can technically go to infinity if interest rates went to 0 and beyond, but you are not shorting some high-flying tech stock that actually has a euphoria about it. This is simply, you're just taking advantage of the fact that the market and a lot of market participants are offside and they're clamoring for these bonds, and they're way overpaying for these relative to the yield that they're providing. All right, we've gone, wow, a whole 15 minutes here. If you found this information useful and helpful and you made it all the way to the end, I really appreciate it. Again, more information about everything we do at Futures on Fire in the description below. And hit that like and subscribe button. Leave a comment if you'd like. I read all the comments. If you think this is crap and there's anything that could be improved, please let me know in there. That would be super. Again, my name is Roderick. I'm lead futures trader at Futures on Fire, which is part of the Traders Dev Group at tradersdevgroup.com/futures. I'd like to remind you to always trade like you mean it. Thanks.